Hi, welcome to today's video and thanks for joining me. Today we're going to be looking at this subject, the mid-year financial review. Now, why is this important? Well, if you're working for someone or you're just one of those goal setters, you always have to be looking at or taking stock of where are you today, where did you begin, and where did you hope you would be at this point in the year, and then you've got another 6 months to go to really achieve all the things you wanted to have happen and all those outcomes that you're hoping that would happen this year. You really want to set those on fire and get going on them, right? So the mid-year review is so crucially important. We're going to be getting into things like portfolio reviews, taxes, insurance, cash flow, understanding your risk tolerance, a lot of different things so that you can really be ready to achieve everything you want to do in the last 6 months of the year. So without further ado, let's get into why you're here today. Okay, so we're going to call this taking stock, just understanding, are you on track? If you are a goal setter, like I'm a goal setter, that's not unusual in the kind of work that I do, but I like to, in November, December, make a plan as to what I want to achieve in the following year and get at it as soon as that calendar turns the new year. But here we are 6 months into that year, so it's important for you to reflect back on what it is that you wanted to achieve in the first 6 months of the year and what do you want to achieve in the last 6 months of the year. So the first question I have for you, and by the way, answer these questions in the comments below so that everybody can understand that you're not alone, that many of you are having the same ideas or the same challenges, and it's helpful for us to know that we're all part of the same kind of community, if you will. So first question is, do you write your goals? Now, it doesn't have to be just financial goals, just are you a kind of person that sets goals? Now, I'm a big believer that it's something that you do, either do it on your birthday or do it at the beginning of the year. A lot of people have good intentions and set goals at the beginning of the year and then they kind of phase out. So it can be centered around your birth month. So when you turn another year older, set goals for the next year of when you're going to turn another year older, instead of it being the calendar year, so to speak. Now, if you did write out your financial goals, where did you want to be by this time? So halfway through the year, and then excuse me, and then where do you want to be the last half of the year? So it's just taking stock of where are you right now and are you kind of behind on what you want to achieve and what needs to change. Okay, so let's talk about cash flow. This is probably the single biggest item that should be on your checklist. Cash flow in businesses, cash flow in personal lives, these are the things that get you into trouble when the cash flow dries up. So in a business, when the cash flow dries up, a lot of bad things start happening. For a couple, for a single person, when cash flow dries up, you have to start making really difficult choices about the kind of food you eat or where you're going to live or how often you're going to drive your car just for pleasure because gas is so expensive. So cash flow is very important. So what I want you to do is take stock of sort of the money in, money out kind of thing. Let's look at this. This is a good visual representation of sort of your life and how you spend money. Statistically, most people spend more money the last half of the year as compared to the first half of the year. That's why I'm having this mid-year review with you, because I want you to really start thinking about what your spending is going to look like. If you looked at the first half and said, well, that'll probably be what the last half is, it's probably not going to be that way. Okay, so did you spend more or less than you thought you did over the last 6 months? How much do you need for the next 6 months, and specifically when, so you can time when you're going to take money out? And why I say specifically and the timing about that is because if you're uneasy about the markets, whether it's this year or any other years, and the markets are kind of choppy or volatile, then you may want to consider how much money you have in cash that you're going to be using that to spend through the next 6 months. So I quite often say to the people that are nearing retirement or in retirement, have 1 to 2 years in cash. You can put some of that money in your checking account that you're going to use on a monthly basis, and the rest of the money just put into like ladder GIC so that those are maturing as you're using up the money. You have GICs that are maturing, right? So it could be 90-day GICs, for instance, that kind of thing. What are the income sources that you're going to be drawing on for the next 6 months? And I talk a lot about, at the end of the year, how you use your tax-free savings account. If you're going to need to have a withdrawal in the next year, then you may want to consider taking that out of your tax-free savings account, because you know that you can replenish it only a few months later in the new year, right? You can't put it back in the same year you took it out unless you've got the space for it. So what are your income sources that you're going to be receiving this money from? And then also I want you to consider, if you haven't already, but I mean, if you're not looking at inflation right now, I mean, you'd have to have been living on Mars to not see inflation. Cost of food is so expensive. Gas is so expensive. Everything has gone up. So what you used to spend, it's a budget, we'll say, think about that as being a lot more than what you're used to. Okay, investments. That digs in right into your portfolio review. So in the January, for instance, I have portfolio reviews with all of my clients. So you might see me as an advisor that talks a lot about doing a plan. And yes, I have standalone clients that I just do plans for, financial plans. But I actually manage clients' money and do their insurance and so on. In January, we do all of the portfolio reviews with my clients, and we look at, okay, what happened last year? What do we need to change, if there needs to be any changes for the next 6 months? So we're not looking at put this in place for a whole year and don't touch it. We're looking at what are the things that we need to invest in over the next 6 months, because in July, we're going to do the mid-year review, like what I'm talking about now. So from January, you did a review, looked at your investments, and got to this point. So now it's time to do that mid-year review. So has anything changed between January to the end of June? Things like your risk has changed, your timeline for when you need money, or timeline of when you're going to retire. Maybe you decided to work a couple more years than you thought, or actually retire early. I hear this a lot when people say that, I've had enough, I'm leaving. And surprisingly, I'm getting a lot of people who are asking me to do the financial plans is they do feel like they have enough money, but they like to leave work sooner. So that becomes a big priority in the plan. Maybe you've had a job loss or a significant illness, and that you're rethinking not just about leaving work early, but maybe you have to leave work early. About 55% of the population leave work early and retire earlier than they expected to because of an illness, by the way. And another 25% of the population retires to take care of those people. Okay, what's the performance of your portfolio like over the last 6 months? Is it on par with what you expected? Is it below what you expected? And when I say how to measure that, you're not asking your neighbor, what did you get as a rate of return? I know it's a little bit tongue-in-cheek. You actually probably don't do that. But what you're trying to say is, based on the performance of what you have invested today, what should you have experienced in that kind of portfolio, so that you can understand whether that portfolio is actually performing the way it should perform. If not, you need to start thinking about why it's not performing that way and make the appropriate changes. Allocations, we're talking about fixed income versus equity. How much do you have in it? So fixed income are things like bonds, treasury bills, cash, GICs. Those are your sort of your fixed income part, and the equity part is just stocks, right? You can have stocks in mutual funds and segregated funds. You can buy them individually. So it's really about what do you have fixed income to equity, and you base that allocation, or that percentage, if you will, off of your risk, your timeline. Those things play a big role in what kind of percentage weighting you should have. You're also looking at things like geography. Are you in Canada, international, US? What kind of sectors are you in? So when we talk about sectors, are you, consumer discretionary spending, financials, technology, materials? These are all different sectors, plenty of them to go into. I've done plenty of reviews in other videos about how to do portfolio reviews, especially about the sector weighting. So have a look at the videos on my YouTube channel for that. And then the last one is, or the second last one is diversification. You really want to think about not just about geography, about being, whether it's US, Canada, international, but diversification within the sector. So the allocation of equity, fixed income, and then the diversification is really terribly important. And the last is tax efficiency. So tax efficiency, I see this so much. It's probably one of the biggest areas that I see. Maybe it's in yours, I hope not, in your portfolio, but I see a lot of people who are in big cash positions and they have either very little or they haven't even opened a tax-free savings account. And so my question to you is, if you believe that you're going to be sitting in that cash position for, we'll call it a significant amount of time, so maybe it's a year or maybe 6 months, then I would say to you, why not move that money into your tax-free savings account so that you can invest that money and not pay any income tax on the growth of that while you're waiting for you to use for whatever that goal was. If you've got room in your tax-free savings account and you've got quite a bit of money that's not earmarked for something immediately in a non-registered or checking or savings account, that kind of thing, then move it into your tax-free savings account, into your spouse's tax-free savings account, and then draw it out when you need it, okay? Speaking about risk tolerance, when you first open your investment account, you did a risk tolerance, and you probably never examine that again. So I would ask you, take a moment just to fill in a risk tolerance questionnaire, and you're going to come up with one of these categories: conservative, moderate to advanced, aggressive, balanced. These are all types of different risk tolerance. And what it really means is it's the percentage weighting of fixed income to equity. Someone who is very conservative is going to have more fixed income than they will have equity, and someone who is very aggressive is going to have almost 100% equity. So I want you to just take a minute to answer these questions and make sure that your risk tolerance is in line with the way that you're investing. If you want to have like a questionnaire, just email me. You're going to get this questionnaire. It's just a PDF document that you can print out, answer the questions, add up the, it's not a big like a math question. There's only, I think, 5 or 6 questions that have values assigned to them. But what it'll do is it'll give you a number at the end of answering the questions, and it'll tell you whether you're conservative or balanced, all these types of things, so that you can then look at your portfolio. Now, when you look at your statement that you get from your broker or your bank, the first page is always going to have, usually the first page is always going to have like a pie chart of your investments. And it's going to give you this fixed income to equity. It's going to also break it up into geography for you. So that's how you can figure out how much equity and fixed income you have. It'll be right on the statement that you get from the bank or brokerage firm. And then you compare that to this risk tolerance that you did, okay? And what you ought to do is do a risk tolerance questionnaire for every type of investment account. So your risk might be different on your RSP than it is on your TFSA. So do one for each. Okay, money market, as a way to dive into that. A money market, I see so many people in cash positions or in tax-free savings account, and they haven't invested their money. And when I ask you about that, most often you're just not sure what to invest in. I don't really get a lot of people that say, I'm scared and worried about the market. It's more of you just not sure what to invest in. And so you're just sitting in a cash position. So I would say to you this, while you're trying to figure out that, go into a money market account. And so what's a money market account? The money market account is essentially the Bank of Canada's rate. So when you hear the Bank of Canada governor talking about lowering or raising interest rates, that's the Bank of Canada rate. You can see these, the Bank of Canada rate is based off of, you see the Treasury bills. And so this is a graph of 22 years of that rate. And you can see the legend there. There's the 3-month Treasury bill, the 6-month Treasury bill, 1-month Treasury bill, 1-year Treasury bill, the 2-month Treasury bill. So that's giving you an idea of how that rate has changed over time. Here we are at the far right hand side. It's not the highest it's ever been, but it's pretty high right now. So you can expect over the next 6 months at least I doubt that we're going to get a 0.5 point reduction in the rate before the end of the year, maybe 0.25%. Looks like the United States probably September will lower their rates by 0.25 point, and I don't think we're going to get any other rate reduction. So that means I don't want to say you're assured, but you can pretty much get above 4% rate of return with very little risk, almost no risk. In fact, so here are the big 5 banks. What are their money market accounts going at right now? He's pretty close to 5%. The actual, that's a 1-year return. The actual return on money market funds is somewhere between 4.7 and 4.8 for most companies, because the rates are starting to come down. But if that would be an easy place for you to sit on your money and get a 4%, at least a 4% rate of return without having to think about anything at all. It's just an easiest decision you're going to make with your money. So let's go into I think this is the last one, or second last one. Taxes. Well, you all know that the capital gains inclusion rate has gone up to 67% in Canada. It's been there before. It's come down. It's been up and down. So people think that means it's a 17% increase of cost to you. No, that's not what it means. There's the inclusion rate. So what is the inclusion rate? The inclusion rate is how much of your capital gain is subject to taxation. So when they go from the 50 to 67, they've increased the amount that is going to be included to be taxed. So we're going from 50 to 67%. So that is a 17% increase to that. But what does it mean for you? When you take the capital gain, you're having to pay 67% of the gain, right? But it doesn't mean a full 67% on your tax return. It actually, because we have a graduated tax return. So what it means is the increase from before, where it's at 50% till now, is actually only really going to be about a 9% increase in the overall taxes to you. So just so you understand, I get so many people saying, should I sell the cottage? This is going to be crushing. And the answer is no, you shouldn't make dramatic changes like that. I would only say, if you need to sell the cottage or you need to sell these kinds of investments, do so because it's a need, not because you're trying to get away from a tax rate. We're already past that anyway, but the real increase to you is only 9%. Now, what are we having this in, or why are we having this in this video, is because over the next 6 months, I want you to think about what happened in the first 6 months. Did you end up selling some properties and you're going to have a larger tax bill? Are you thinking now, based on the next 6 months, will you owe money or are you going to have a refund? So I want you to think about how to use your tax-free savings account. So let's say, for instance, you have a significant amount in your tax-free savings account. You could do a withdrawal in December, use that money to make an RSP contribution, get that money back in the new year, and put that money right back in your tax-free savings account with the return that you're going to get, or the refund that you're going to get. So that would be an excellent way to help you if you've got the unused contribution rooms in your RSP. So that would be an excellent way for you to help yourself to pay less taxes in the new year. So think about how you use your tax-free savings account in combination with your unused contribution room of your RSP. Last one, and then we're done. How you doing so far? You like this video? Remember to hit that button right down there that talks about subscribing to the channel and also liking the video. And I love your comments. Keep giving me your comments because I love your comments. Now, I get this question quite a bit in reviews. What should we do with the insurance that we've got? We're 57 years of age, or we're 65. Do we still need the insurance? So I want you to really just ask yourself these questions. What was the insurance for? Invariably, I always hear, we got it when we were younger and we had kids and we had all this debt, and now we don't really have that debt. The kids are kind of independent, so do we really need it? So what is the goal for that insurance now? Is it still relevant? Is that need still really there? So many times you'll have term insurance, and that need was when you were younger and you had the most amount of liabilities, so debt and responsibility for income replacement. Kids are grown up, you've grown up, you don't have the debt, so is that really there? Probably not. And the cost for the term insurance is likely skyrocketing because of your age. So it may not be relevant anymore. For your whole life insurance, what you look at, is there going to be a change? So the term insurance, we know there's going to be a change. But with the whole life insurance that you might have, you start looking at, well, what's the cash value? What's the dividend that I'm getting on the insurance? Is the premium going to go up or down? Usually whole life, it doesn't change like that. Could in universal life. And you want to know whether or not it will cancel or terminate at a certain time. Many of you have term insurance with your work employer, and that when you leave work, that insurance is gone unless you convert it. So this is the time for you to start examining what is your actual insurance. If you're thinking about retiring in the new year, you're looking at your insurance saying, hey, if I actually do retire in January, we're going to lose this insurance. So what's our insurance need? For your whole life, there's something called premium vacation. What does that really mean? It means you've got enough cash value in your policy plus the annual dividend that would actually pay the premiums, the monthly or annual premiums on your insurance. So you don't actually have to take money out of your bank account and pay for that. So all you need to do is contact your insurance advisor. If you don't know who that is because it was somebody that sold you it and they never contacted you later on, just call up the insurance company. They'll verify you and you ask them a question. Can I stop paying for this and it'll continue? So you can even use the word premium vacation if you want to. And that'll give you some savings and still maintain the death benefit, okay? So you don't have to keep paying for the policy. 1, do you have a financial plan? If you don't, how come you don't have one? What's stopping you from getting a financial plan? Is it the cost of getting a financial plan? Is it the time involved? Is it you think you don't need one, or you're just putting it off? Often I find people put it off because they're just worried about what the outcome might look like, what the answer might be. And I would encourage you to just take the time to get a plan done, because I haven't met anybody yet who has asked me to do a plan that is disappointed about the outcome. They're actually very relieved about what the outcome is, and they're looking forward to retirement. Okay, here's your question that I'm going to ask you. I want to know, what are you looking forward to the most in the next 6 months? So what is it? It could be a personal achievement, it could be saving for something, it could be can't wait for the winter because you love skiing, or getting ready for the fall because you like the changing of the colors, or getting excited about traveling somewhere in the new year. Put there what is you're looking forward to in the next 6 months. Everybody loves to see and these kind of comments. So I'm looking forward to your comments. Again, thanks for joining me in today's video. Really enjoyed giving this information to you, and I look forward to seeing you in the next video. Thanks and be well.